Hi, everyone. Welcome to the Dream Builders Insurance Podcast. I'm Carissa.
And I'm Marcy.
And we are so happy to have you today. Today, we have a very special guest with us. His name is, I'll let him introduce himself.
Hello, everyone. My name is Gary. First, I just want to say thank you so much for having me on the podcast and looking forward to see how it goes.
So, Gary, I think the first thing is that people should know is that you are 23 years old and you're having massive success helping clients. And I think what got you into the insurance industry? I mean, what about it attracted you?
Yeah, I appreciate it. I wouldn't say massive success, but I'm doing okay. In terms of what got me into the industry, it was initially while I was in college. I was in the second year of college. I was studying environmental science, and I was looking around my peers that graduated, and I didn't really see a career path ahead. Because usually how it goes is like you do internships, 2 years of internships, probably unpaid. And once you get into the workforce, you have to start like a $40,000 a year salary. And that's given like a bachelor's degree at UCSD. And the entire process, it takes like 20 plus years for you to even get anywhere near six figures. And I just couldn't see myself being in that career path because, I came from a pretty poor family and I want to be able to help my family, or my mom specifically, be able to not have to worry about money. So my friend at the time, my really good friend, he introduced me to sales. He was doing sales, and I got into a phone sales, like outdoor door knocking kind of thing, knocking on like 200 plus doors a day in the hot summer. And on one of the days, on the very last door that I knocked, I tried to pitch this guy to sell a phone. And then this person, his brother, pitched me back. And his pitch was way better than my job. And I was like, wow, I could do way better if I'm busting my ass doing this every single day. So that's like how I got into the industry.
Yeah. So when I say massive success, I mean, it's more about like information for clients, but it is massive success when somebody 23 years old is able to make that decision of like, hey, I want to go into the insurance industry and to be able to help clients put them in a better position. Right. So, tell everyone like what your focus is currently.
Mm-hmm.
Yeah, my focus right now is currently more towards the advanced planning side of insurance, more of like the IULs, infinite banking, potentially higher net worth clients with premium finance. That's the area I want to become more focused on.
Nice. And that's something that a lot of insurance agents don't do. So when you say IUL, what does an IUL do to help, just for the sake of our listeners who, not be familiar with the term? How does an IUL help a client?
An IUL is short for Index Universal Life. So you're able to have like a sort of a mixture of accounts where you have insurance at the base of it, and you also have a savings component where you can grow your money, which is the cash value. And the cool part is that it mirrors whatever index fund you have. It could be ETFs, it could be S&P. And when you mirror it, part of the money you have in the cash value grows along with it. And you could, if you structure it correctly and you maximize cash value, it can actually be really good for a tax-free retirement. Sort of like creating your own pension in a way.
Wow. So
Gotcha.
What has, sorry, Marcy, I should let you ask, but yeah, go ahead.
Yes. Just ask the question because I have a couple of them, so you go right ahead.
So more on that. So how do you use, because I wonder, we haven't talked a whole lot, right, Marcy? You haven't talked a whole lot about IULs on this podcast. So Gary, What would be your approach for someone who's preparing for retirement? Maybe someone who's in their 30s, 40s, or 50s, what would be your approach to helping them set up their own IUL?
Yeah, every situation is different. I hate to say it, but it kind of depends. But let's just say for a 30, 40-year-old person, assuming they're already saving for like a 401k, if they're, for example, max funding it, and if they think taxes will increase in the future, which is a pretty likely chance, just looking at the debt, our government programs that we have to sustain, if taxes increase, if they're max funding their 401k and taxes increase in the future, that means Uncle Sam's going to take a big chunk of their retirement account, and they may not be prepared for it. Which is why, if they're max funding it, you could potentially reallocate some of the money that they're overfunding. Anything above the match is like a rule of thumb to kind of reallocate into an index universal life, where you could sort of diversify your assets. Not only have a tax-deferred account, but also have a tax-free account where you don't really have to worry about the government like taking hold of your retirement asset.
Right. You bring up a really good point. So I can just tell you that, we've been doing this long enough. I've been doing it like 6 years, and I can honestly tell you the point that you just said about how they're maxing out with their 401k is that I actually sat with somebody whose company matched them 3%. Okay. And they were putting 25% in there. And I was like, the match part, okay, you can't lose as much because you're being matched, but you can better allocate all that additional money. Plus, you can lose it in 2 seconds, right? So I think that that's really important. So what has your client base been like for you so far since you started? Age-wise, too.
Age-wise. So in the beginning, with the practice company, it was really more about war market stuff. I wasn't digging that stuff, and I didn't really follow the system for there. So I kind of did a lot of social media and like LinkedIn outreach, and I was targeting mainly like nurses, medical professionals, and some real estate investors. I had some success on that. It was okay, and the age range is more like 35 plus.
Okay.
But how about now that you've been, these last few months, what's been your age range now?
Age range, it really varies because we have, again, that lead source that we have is really great vendor, a pension. So it's pretty much any university employees, and it really ranges depending on who books on my calendar.
Got it.
Correct.
Okay.
Got it.
Okay.
Got it. So do you feel like, do you ever get nervous or feel uncomfortable if you were talking to somebody who's getting close to retirement, like Carissa was asking you about? Do you ever feel like they're like, hey, this is just a kid, what's he going to tell me about retiring? Do you ever like get that vibe or that sense from people? Yeah,
I used to be a little scared for my, personally, like in my own head. I just get in my own head, and I just realized that age is just a number. As long as you're able to provide value, show them that you know your stuff, I think it shouldn't matter too much. Especially, sometimes I could feel on their end. I can just feel, we're not in person. I could feel the energy in the way they talk, but I just don't let it get to me. Like, hey, I could help you. You don't really have anyone else that could provide this type of service, and I could do it for you. And I just want to be able to educate them and show them exactly what their situation is like and what way we could provide solutions.
Right. And that's kind of where I was kind of going because, it was all new to you when you first started, you know what I mean? And I think people have to understand is age really has no factor in someone being able to help you and put you in a better situation. And that if you study and you listen to all these people who know exactly what they're talking about, then you're okay. And then age doesn't matter. So, I give you props for that, dealing with that. one other question I just wanted to ask is because you brought up infinite banking. So can you tell us, our listeners, what that is? Because we haven't gone there yet either with
So
them.
infinite banking is when you use a highly customized participating whole life so for infinite banking, it really boils down to a very specific situation. It's really only good if you have like an investment you want to make, like in the short-term future. Like let's say after 30 days to after 30 days to 2 years, like, and you want to make, like, for example, a real estate investment, and you have a lot of capital for your real estate investment that's just sitting there in a bank account that's not doing anything, and you're losing money against inflation. A good way to be able to hedge against inflation is by dumping like a decent amount of a lump sum into a whole life, participating whole life, so that you could grow it at that guaranteed. I don't want to say guaranteed, but it's almost guaranteed, because out of the last 300 years, only one of the years they weren't able to pay that the dividend that they give out, which is somewhere around a 4 to 5% internal rate of return. And if you want to have that guarantee, you have a lot of capital as an investor, you can dump it in there and pretty much have uninterrupted compound growth while also taking a loan from it, tax-free, do your investment, do a fix and flip, get your profits, put it back into the infinite banking, and it's sort of like your own bank account at that point.
Wow. So what are the implications of infinite banking I love that, besides just being able to help people, with short-term investing, basically borrowing money from themselves, from their own bank, to be able to invest in real estate or whatever. What else can you use infinite banking for? What else can you use participating whole life plans for?
For example, if you want to do like a car business, loan out cars, that could be an investment. You could do that for that.
Nice.
That's just one example. I mean, there's like a lot of different investments you can do and utilize it.
Do you ever use it to help people get out of debt?
Oh yeah, there's a debt-free life. We have like a software that we use, and pretty much input all their numbers utilizing a snowball or avalanche strategy. And we also added the participating whole life component where they could have that growth. So put all the debts to a minimum, and all the any money that they overfund the debts, it gets reallocated towards the participating whole life. This way you could grow your money while also get rid of your debts once you hit like a certain point, and you pay off one debt, reallocate those the money you've been putting to the minimum, and also the overpayments directed back into the participating whole life. And it's like a loop that you could get rid of your debts while also building an asset for yourself.
And not spending any additional money. I think that's really important for people to understand, because you're reallocating, doing the snowball or avalanche. Cool.
Yeah.
That's brilliant. I love that. It's like, you might, maybe, again, going back to the overfunding of 401k, maybe instead of, maybe if the company is only matching you 3%, you take some of that extra money, you put it towards your your debt-free life accounts that's building cash value, and then able to pay off your debts faster. I'm helping one client who's going to be able to pay off his mortgage in a third of the time, plus get rid of all of his other consumer debt, just by using participating, an overfunded participating whole life. So yeah, it's incredible what you can do with those, with the infinite banking.
Right.
Yeah. It's awesome.
So how has social media been for you? Like, as far as attracting clients, because like Carissa was saying earlier before we jumped on, is, I follow you, I follow Dustin, everybody. And, there's so much knowledge that you're pouring out. Have people been receptive, and are they direct messaging you?
Yeah, so I started around 3 to 4 months ago, I believe, and I've just been posting every single day. It's one video, Monday to Friday.
Mm-hmm.
That's not every single day, but every single work day, at least. And it was really until 2 weeks ago I got one video that pretty much kind of got viral. It's got like 300 something thousand views on it. Super excited about it, and I got some people to DM me, and it's really great being able to finally see the fruits of my labor, like 4 months, and finally people from one video. It's pretty amazing how it works. I was expecting more like waiting until 1 year, but hey, it's quicker the better.
Yeah. What was that video on?
It's about infinite banking.
Nice.
Okay.
Nice. So you want to give us like a little summary of what it was, what the video was on? I mean, what the concepts you explained?
Yeah, so it's pretty much similar to what I explained earlier about infinite banking and being able to utilize the cash value. And it was a reaction video. So it wasn't even me to explain it. So that's the funny part. So I was reacting to it and I gave my take on how to properly structure one of those infinite banking accounts.
Nice. That's incredible.
Right. You can take the knowledge of someone. You can do that side by side, or you can let it play and then you give your point of view. So that's pretty awesome. I think, what about annuities? Have you been successful helping people with annuities? So rolling over their retirement or money, old 401ks, or money in the bank that's not getting any interest, really?
Yeah, absolutely. With the lead vendors we have, annuities are a pretty common topic since a good amount of them are wanting to prepare for retirement, and they only have like a 403b, 457, and they realize after this year, just 1 year can lose 15 to 20% of their entire account value. And just looking at this next year, there's a lot of mixed feelings about whether we're going to have bullish or bearish, and a lot of people who are near retirement, they don't want to risk it. And a good way to not risk it is by protecting your retirement, by preserving your wealth, having a price floor from like a fixed index annuity, never lose money, while still having the upside potential to mirror like an ETF or S&P.
Can you break down for us, because again, we haven't talked about annuities on this podcast either. They're extremely powerful tool. Can you break down, and not all annuities are created equal. So can you tell us about the type of annuities, like the fixed indexed annuity, which is to me is like the perfect answer to all of the annuity problems the complaints that people have with annuities. To me, it's a perfect answer. So can you break down for us exactly how it works?
Yeah, absolutely. So for a fixed index annuity, how it works quite similar to the index universal life in the way that it mirrors whatever index fund you have. So essentially, if you have like a Roth account, if you want an annuity, the annuity just puts on the sticker of annuity, so that this way, if you have that sticker, the insurance companies contractually guarantee to have you a price floor, which means you never lose money. You guarantee to not lose money. And then whatever index fund, ETF you choose, you can mirror what it does. And the way that and sometimes you even have like higher participation rates. And participation rates means that, for example, if the S&P does 10% and our participation rate is 200%, you do 20%. So that's a pretty cool part about it.
Wow.
Yeah.
That is awesome. So because a lot of times people will say, oh, I actually have a family member who said this, like, oh, I don't want to put my money in an annuity. I want to just keep playing the ups and downs of the stock market. So what do you do to people who give you that objection? I'm sure you've heard that before. Like, I want to keep riding the ups and downs of the stock market. I don't want to have something where maybe I can't earn 50%. You know, I want to, and it's okay if I lose 20%. I just want to be able to earn the max that I can, even if I can lose money. What would you say to someone like that?
Well, if they're doing something like that, I would just do the math for them, essentially, and show them what kind of situation they're at. For example, if they have like a $1 million nest egg with a 401k or 403b, you can only take out 4%. And nowadays, they're putting articles that it's not even 4% anymore. It's more like a 3.3%. So let's just use 4%, for example. 4% of $1 million, that's $40,000. And if the market, I asked them, can you guarantee that the market will never correct itself during retirement? You're probably like, no, it's always going to correct itself. Every 7 to 10 years, the market dips and corrects itself. And if you forecast yourself taking out income from your $1 million nest egg, $40,000, by the time that the market corrects itself, that $1 million nest egg is not going to stay the same. It's probably going to dip 15, 20, 30%. If that happens, your retirement's at risk. And one way we could solve it is by protecting yourself from the downside, and that'll never happen. And again, if you do have like a 401k, 403b, and you use it for retirement, the asset allocation you have is probably more towards bonds. And it's probably going to have minimal growth. And if the market does crash, bonds are not certain to go up when the stock market crashes. Just like in '08, these bonds did not go up. And still a potential risk.
Yep. And we saw that, right, in
Gotcha.
2008. That's why people were jumping out of buildings, because they lost like 40% of their retirement. You know, here they were looking, I think people even came up with a nickname for 401k. I can't remember what it was, but it was, if their people's 401ks were so bad that people are like, great, I was planning on retiring in a couple of years, and now I'm going to have to work for several more years just to try to make this up. And then we saw in 2020, during COVID, when we had a massive, we had a correction. Like it keeps happening. This year, I had someone who had remember, Marcy, we sat with a client that had almost $1 million and lost $250,000 in 1 year. So, and it takes a lot to be able to make up for a loss.
Like, I just sat down with someone last night, and she told me she had an advisor that has been working with her for 15 years, and it was with one of those big name companies, Morgan Stanley. And for those big name companies, if you're not having like $1 million plus asset, and you have an advisor, they hardly do anything for you. They're hardly managing money, throw you in a target date fund, and target date funds are not the best asset allocation. And she started off with 150,000. 15 years later, it's been up and down, and now she's still at 150,000. And I feel like, yeah, exactly. And there's a lot of people out there that probably has an account like that too.
So what does that mean for someone with the sequence of return risk, which people don't like to talk about when we're talking about retirement? What does that mean for someone's retirement if they lose a bunch of money? Let's say they're 65, they're retiring, and then they lose 20%, 30%, over time in the first few years of retirement. What does that mean for their retirement if they've got it in an unprotected?
20%, you need 25% to get back to square one. If you lose 30%, it's closer to 45. Lose 40%, that's 67% you need to gain back. So if that were the case, that either have to, one, find some way to grow it back to that amount, or they have to work longer, and that's probably not preferred. Or number three, those are just the two. So there's no third one.
And they could actually end up, like you said, running out of money when they need it the most, right?
Yeah, exactly.
Yeah.
Right.
Wants that.
I feel like that's really our job, is to educate people and make them understand that, things can happen in a second when they're playing, especially in the stock market. And for me, when I'm with clients and they've been working their whole life, when they're closer to retirement age and they have their money at risk, it makes me really nervous. Just personally, it makes me nervous, but I'm more worried about them because we work so hard to build up that value, our retirement, that the last thing we need to do is make all that work irrelevant, because now we're just living on Social Security, right? So I feel like it's super important for people to really understand, even though some people have negative thoughts about annuities, but it's just lack of education about how they actually can help you.
Exactly.
Right?
Absolutely. People have like a bad connotation because of it, because in the beginning, in the early years, it's just a fixed annuity. You didn't really earn too much percent, 2-3%, not too much. And then there's also a variable annuity where it was actually directly tied to the market. And a lot of people got burned because the agent that helped them didn't really take a look and keep keep a sharp eye on what the performance is. They just set and forget it, and that's not really the best way to navigate a variable annuity. Is really high. There's also a management fee, and then the turnover ratio, because then you also trade a lot within the mutual fund for the variable annuities. So just
Right.
be enough alive.
And so right now, folks, we're really focused on doing annual reviews. So Gary, to your point, is for an agent to set it and forget it, especially with an annuity. It's not like it's a term policy where we know that there's going to be no changes. This is something that needs to be reviewed every year so that we might have to change the fund that they're going with, how they want to allocate their funds based on the performance, right?
Mm-hmm.
Yeah, absolutely.
Yeah.
And I know one of the biggest objections people give to a fixed index annuity, I've heard it from clients, I'm sure you have it too, had to, is, oh, I won't have access to my money. My money is completely tied up. What is the answer to that?
Within the first year, you could probably go with like a multi-year, I believe. The one that you could, or flex for one of our carriers where you could actually access it within the first year. Okay. And the cool part about the other ones, like accumulation products, is that there's a 10% free withdrawal. So if you're planning to use it for retirement anyways, you could take up to 10% of your account value each year and get an income from it. And if you have 401k, you're going to take out 4% of it anyways. So if you were to protect yourself, you can have more than 4% withdraw, 4 to 10%, and you'll still be able to adjust for inflation down the road and never lose money.
Yeah, and it's really just for a certain period of time, right? So it's really usually just for that 7 to 10 year period that they can only take out 10%. And after that, they could take out the whole amount if they wanted to, you know? But like you said, way better than 3.3% that people were saying now that you should only take out of your 401k. So it actually gives you a whole lot more flexibility. And then in the case of like, they usually, a lot of them, don't they also have riders that allow you to take out the whole account value early in the case of like nursing home, terminal illness, something like that?
Right. Confinement.
It's called Care Matters. It has like a long-term care built into it. Nice. That's a cool part.
Nice. That's awesome. Which is a huge expense and always looming over the head of our retirees, right? That long-term care, because they say it costs, what, $100,000 a year on average? So, yeah.
Yeah, could even be more than that. You know, it is a death benefit. Annuities are a death benefit, but it's a living benefit. And, you know, we can, at 72, most people, if you start an annuity at 50, at 72, you need to start taking the minimum required distribution. And I think people don't realize that that's, you know, they might have their Social Security, but then they also have access to this annuity for that money every year. So I think that's important too. I think it's more of a steady way to go for retirement, and I think more of a peace of mind for sure. For sure.
Oh yeah,
absolutely.
That's true, Marcy. You brought up a good point. So Gary, because sometimes people get concerned, they give all their money to the insurance company, and then if they die in 5 years, right? What happens to all of that money? For a fixed index annuity, it's different from some of the other annuities. What happens to the fixed index annuity if they were to die right in the middle of, they just gave, $1 million to the insurance company and then they pass away in 5 years? What happens?
Avoid probate too. If you have an account like brokerage mutual funds, that may go into probate unless you sign some sort of contract that specifically says have a designated beneficiary. But if you don't have it set up, there may be probate and a legal battle and taxes on it. Whereas for this one, there's no probate, no legal fees for that.
Nice. So that money just goes straight to the beneficiary, and then they just have to worry about, paying taxes, of course, as they withdraw, but still they can treat it as an IRA. That's incredible. That's awesome. Love it.
Yeah.
Well, good. Well, we're wrapping up coming to the end of our podcast here. Gary, any closing thoughts? Anything else you wanted to mention and you believe you could help? Oh, and also, how can people get in touch with you if they want to do business with you? If they're like, man, this dude is smart. I want him to help me with my retirement, help me protect my family. How can I get in touch?
Great. Thank you both for having me on the podcast. Really enjoyed talking about and sharing about my story a bit today. In terms of my social, you can follow me on Instagram, Gary_J_Guan, or my Facebook, which is Gary-Guan-7, I think. Yeah, I think that's it. Or LinkedIn.
Awesome. Thank you so much.
Yeah. Thank you, Gary. Really appreciate you joining us for sure.
Yeah, I really
All right,
appreciate
folks. Yeah, we're wrapping up, and we will see you next
Thanks
week.
for joining.